Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to talk about 3 Canadian stocks that are close to their 52 weeks low share prices, and I am considering to start a position in these companies. Being close to 52 weeks low doesn't mean you should buy a stock, but it means this is probably a good time to start looking at the fundamentals of each business and evaluate these companies. I want to go through financials of some of these companies and share my perspective on these stocks with you. Sorry for lack of content in the last month. I was dealing with a health issue, but all is good now, and I'm working on a bunch of videos to release in the coming days. We have a lot to cover in this video, so let's jump right into this. The first stock, which is at its 52 weeks low, is Canadian National Railway. This is one of those high quality businesses that I always wanted to own, but the valuation was never compelling enough for me to start a position. CNR share price was at 175 Canadian dollar at one point this year, and now the share price is down to $148, pretty close to its 52 weeks low. At the first glance, it doesn't look like much of a dip, but for a stable business like CNR, this is actually a pretty good dip in the share price. Canadian National Railway owns and operates railways and related transportation businesses across a 20,000-mile network in Canada and US, which we can see it here. CNR is not only operate a railway business, it is basically a supply chain provider and owns trucks, vessels and docks, transloading and distribution, automotive logistics, and freight forwarding and transportation management services. They are basically a fundamental player in supply chain in North America for transportation of the raw materials, energy products, and goods. The only other company which owns railways in Canada is Canadian Pacific Railway. As you cannot build new railways and there would be absolutely no competition for CNR, and as CNR services is crucial for North America's economy, CNR has a very strong business moat, and in my opinion, it is one of the safest business models and companies in the world that you can invest in. CNR has a long history of paying out and increasing its dividend year over year. They more than doubled their dividend in the last 8 years. And at the same time, they bought back the shares of the company, which is definitely one of the most consistent records and one of the fastest dividend growth rates and value return to shareholders among all of the Canadian companies. They also have a low payout ratio, which means they will probably able to continue to increase this dividend year over year for foreseeable future. In terms of the valuation, CNR is currently trades at a discount compared to its historical averages with a P ratio of 19 and a price to cash flow of 13.4. In terms of the profitability, this business has a return on invested capital of 15.5%, which is great in my opinion. While this downturn in the economy and demand can lead to short-term decline in the revenue of Canadian National and probably a slower growth in the next couple of quarters, I think long-term this company is a solid choice for any portfolio. My portfolio in particular lacks exposure to industrial sector, and I am currently considering adding CNR to my portfolio at these levels. The second stock, which is at its 52 weeks low, is Canadian Tire. I used to own this stock in the past, but sold my shares when the share price hits a 52 weeks high at around $190 a few months ago. With a weak retail activity and higher cost of living for Canadians, Canadian Tire earnings was not great in the past quarters, and as you can see, the share price of Canadian Tire stock dropped close to its 52 weeks low levels again. The company operates in 3 segments: retail segment, real estate segment, and financial services segment. It's hard to say what type of business Canadian Tire is overall. Some parts of the brands and services are crucial services, and some of the products are discretionary products and services. And that's why I personally consider Canadian Tire a company with both consumer staple and consumer discretionary characteristics. Canadian Tire store itself is almost a Canadian version of Home Depot. The company also offers car services, and also they own other retail stores like Mark's, Atmosphere, Party City, and Sport Check. Canadian Tire also owns Canadian Tire gas stations, which is another crucial service that they offer. They also own a few brands like Helly Hansen in clothing and Master Chef, which has gas grills and some kitchen appliances. And also they have their own financial segment via Triangle MasterCard and Triangle Rewards programs. So as you can see, Canadian Tire owns and operates a wide range of stores, products, and services, and that's why it is a very diversified company with a complex cash flow structure and accounting measures. The stock is paying a nice dividend with a starting yield of 4.6%. Canadian Tire has a long history of paying out and increasing its dividend year over year. They basically tripled their dividend in the last 8 years, and at the same time, they bought back the shares of the company aggressively every single year. Last year alone, they returned almost 9% to shareholders via just dividend and share buybacks, which is impressive. I really like what I'm seeing here in terms of the buybacks and dividend increases. The company also has a relatively low payout ratio, which means the dividend of the company is secure and safe for now, and they have room to increase this dividend in the future. In terms of the valuation, Canadian Tire shares currently trades close to its historical averages with a P ratio of 19.9 and price to cash flow of 13.6. It's not a screaming a buy, but this is probably a good time to start to look at the fundamentals of the business more closely. In terms of the profitability, the company does not have a good return on invested capital at the moment. It is less than 10%. It's actually close to 7%. But the management of Canadian Tire expect their return on invested capital to exceed 15% in the next couple of years, which means they predict to double their profitability, which I'm not sure if they can really achieve this. Overall, I think Canadian Tire is definitely an interesting stock to consider here for your portfolios, especially if you want a diversified business with a relatively high starting dividend yield, but you should also consider the limited growth potential of this business as they currently only operate in Canada. I personally will watch the stock closely in the next couple of weeks. The third and last stock, which is close to its 52 weeks low prices, is Northland Power. My portfolio lacks exposure to energy and utility sectors, and Northland Power can be a nice play in these sectors of Canadian market. This is a company that develops, builds, and operates green power projects in different countries around the world. The company produces electricity from wind, solar, hydropower, and biomass, but their main focus is on offshore and onshore wind turbines. They pay a dividend with a starting yield of 5.2%. The 52 weeks high share price of Northland Power was 43 Canadian dollar, and their all-time high share price was close to $50. And the stock is currently trades close to its 52 weeks low at $23 per share, which means it is down more than 50% from its all-time high share prices. I analyzed this stock in detail in the past and concluded that Northland Power was overvalued and its fair value was close to 26 Canadian dollar. As you can see, the stock is currently trades below its fair market value based on my previous analysis, and is now trades at an attractive valuation. Its P ratio and price to cash flow are also both lower than the 5-year average of the stock. The company, however, does not have a good track record in increasing its cash flow and dividend, and their dividend was basically flat in the last couple of years. They also have lots of issues with high interest rates on their long-term debt, and therefore you can expect lower earnings and even potentially a dividend cut for this company. So this one is a little bit more risky comparing to the previous two stocks. I'm watching this stock closely, and there is a good chance that I want to start a new position in this Canadian green energy company, especially if the share price drops more to give me more margin of safety. Overall, this is an interesting stock to watch at its 52 weeks low. There you are, guys. I hope you enjoyed the video and my coverage of 3 Canadian stocks that I'm watching closely, close to their 52 weeks low share prices. If you enjoyed this video, make sure to subscribe to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.